Hello and welcome to our special monetary policy coverage coming to you straight from the Reserve Bank of India headquarters. It's a doubly important day for us. It's our 23rd birthday, and I must thank the Reserve Bank for remembering that way back in September and fixing the monetary policy on a day which is very important for us as well. As you can see, I am in amber and green. Cautious and positive, I guess, is what the Reserve Bank will be for the markets as well. Along with the monetary policy, digitization has been a big theme of this year from the Reserve Bank. So my colleague Ritu is actually joining from India's Silicon city of Bengaluru. Hi Ritu, good morning.
Hi, good morning, Lata. And, we're watching out for what the governor says. Of course, any comments on fintech, as always, Bangalore will be watching out for. But the markets seem to have penciled in a 35 basis point rate hike from the RBI. But the focus is really going to be on the stance. Will they tweak it or will they not tweak it? Will they retain it at withdrawal of accommodation? That is where the focus is going to be. No changes are really expected on the macro parameters, whether it is 6.7% CPI or the 7% GDP growth forecast for the current fiscal. Let me quickly introduce the guests that we have to decode the policy for us. Bhardwaj, the chief economist at HDFC Bank, joins us. Also Saugata Bhattacharya from Axis Bank. We have Kaushik Das from Deutsche Bank and Lakshmi, who's also joining in from Kotak Mahindra AMC. In a short while from now, we'll also have Amandeep Chopra joining us from UTI Mutual Fund. But Lata, first let me toss it to you. The expectations are clear, but could any surprises pop up?
Well, you summarized the poll very well, and of course we'll ask our guests what they make, whether they have any different opinions. I think I would first of all say that yesterday and day before yesterday's rupee fall comes as a very important warning. There is a limit to the dovishness that we can expect because the external sector still remains somewhat vulnerable and vulnerable especially to global cues. The Reserve Bank will have one eye on that. So one mustn't run away with any dovish expectations. I would also want to draw the attention of everyone who parses the policy very closely to para 10 of last year's statement. Just pull that out and it will be a useful reference point. There are two statements over there. One which says the MPC is of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, restrain broadening of price pressures and preempt second-order effects. The other sentence, the MPC has decided to increase, the MPC has also decided to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward. Both these are actually extrapolations of the stance. How do they change this sentence? Calibrated withdrawal of accommodation, do they continue to say that? Do they continue to say inflation expectations need to be anchored? We have to watch out for that, is my guess. So caution could continue in the Reserve Bank's language. But with that, let me hand it over to the experts. Bhardwaj, what will you watch out for?
Well, I would watch out for the forward guidance, and I'm glad you mentioned the turbulence in the rupee market. And if you just look at what led to the turbulence, and if you're indeed looking for causal factors, I think it was a more than robust expected print for US unemployment, for the US employment numbers, the non-farm payrolls, which I think solidified the expectation that while the pace might moderate in the Fed hiking rates, it will possibly be a longer, a more prolonged rate hike cycle. So what if the Fed is indeed setting the template for other central banks? How does the RBI take cues from that? I think the additional factor, of course, is the revival of China with zero COVID kind of getting diluted, and and China is potentially likely to suck out capital from other emerging markets because there is sort of a newfound bullishness on the China story. So given all this, and assuming the currency is indeed a concern for the RBI, how the RBI sort of handles this and how it plays out is of the critical importance to me. The other thing, of course, that I quickly want to mention is the fact that even from a domestic perspective, I think the stickiness of core inflation, which simply refuses to go down, is something that the RBI would have to take into account in setting monetary policy going forward. The battle against inflation is not yet over, and I think the stickiness of inflation is affecting affordability. It's sort of adding to the inequality, if you like, of the recovery, the a sharpening of the K-shape and so forth. So I think these are concerns that one has, and how the RBI addresses this is really of critical importance this time.
Saugata, what would you be watching out for? I mean, a tweak in the stance is what everybody's been talking about. What specific tweak are you expecting in the word? And of course, the split vote, on the decision itself, that is also an important factor.
Exactly. So thank you, Ritu. So I probably 35 with some tweak in the stance, not neutral yet. So play on the focus of withdrawal of accommodation, probably somewhere. I think this is important from what Avik said. Inflation remains sticky, but my sense is that we are approaching the terminal rate. We are at 6.5 for the terminal rate, if we are correct on that. So the need to actually communicate that while we are approaching the terminal rate, markets should not get too far ahead of themselves, because that will neutralize some part of the if financial conditions begin to ease. So the communication and the balancing between moving to a terminal rate, the reason that I'm saying that the need to be careful is that we are already seeing some signs of a slowdown. I'm worried that a continued pace of rate hikes will not have a linear reaction. You will get some non-linearity at some point in time, some tipping point, which they need to keep in mind. So that communication for markets, as well as mindful of the real economy, that will be the critical balance that the MPC will have to deal with.
Yeah, Saugato, I would not be surprised if the RBI even wanted a bit of slowdown, especially when you look at the external sector. The Indian economy firing on all cylinders has meant that it is consuming more imports. And the fact that the world is not growing as well as India means we are selling fewer exports. Now that is a worry. I wouldn't be surprised if the last 2 days fall in the rupees because somebody has an inkling on the November trade deficit, which is probably uncomfortably high. So Kaushik, on that, should not the Reserve Bank actually be interested in tempering consumption in India because it's leading to too much of import consumption?
Hi Lata, good morning, and very good point. And just to summarize, we are also going with a 35 basis points rate hike call. And we think this will be the last rate hike from RBI in this cycle. So it's important how they communicate that. They'll obviously not tell us that it's the last rate hike, but they'll probably kind of change the stance. Maybe one option is change it to neutral, because that gives them the maximum flexibility of wanting to hike at some point of time or pause, or even consider a cut with a certain amount of pause. So neutral could be a good strategy at this point of time. Or what they can do is tweak the language and say that the MPC remains focused on withdrawal of accommodation, while acknowledging that the substantive amount of cumulative rate hikes that have happened are yet to kind of filter into the real economy, because transmission happens with a lag, which would go to signal that the 300 basis points odd hike that the money markets have taken in this year, RBI has done quite a lot. And beyond this, RBI can be in an autopilot mode and allow inflation and growth to reach its desired level. To your point, the only thing that RBI can do on current account side is to lower the non-oil, non-gold imports momentum, because RBI doesn't have control over oil or gold. So the best they can do is slow down the economy to some extent so that the current account deficit comes down to some manageable levels of financing. I think by the time we go to next year, current account will be at about 2.5% of GDP from 3.5% of GDP in FY23. But the absolute number will still be high. We are expecting current account to be 90 billion next year, which is still a big amount to finance. So therefore, rupee, in my view, for the time being, will remain in the range of 80 to 83. RBI will not want rupee to breach 83. At the same time, if there are flows coming in the next year, I think RBI will buy a lot of dollars and keep rupees stable within 80 to 83. The thing to watch out for would be RBI's focus on inflation, the forecast that they'll give for July, September, and whether they give a number close to 5% for July, September as well.
Okay. I'm sorry I'm interrupting you because we're only 2 minutes for the governor to start. Lakshmi, what is priced in? What if it were 25 basis hike, not 35?
Hi Lata, good morning. So I would say that bulk of the news of a 35 basis point is already priced in. If it were to be a 25, it therefore will indicate that it's not done yet, because the underlying stance or the accommodating policy guidance is going to be very critical. As we speak right now, whether it's the OIS curve or the the cash market GSEC curve, both are kind of pricing in. Market is kind of toned between 25 and 35, bulk of them still voting in favor of a 35. But the accompanying stance, I think, is going to be important today more than the actual quantum of the rate hike decision. I think that's going to be, very, very excruciating watch, at least for the markets right now.
Well, Amandeep, I'll toss it to you as well. The stance, like Lakshmi said, is going to be the most crucial. You factored in a 35 basis point hike as well?
I think at the present juncture, markets clearly are with the consensus. So it's a dovish hike, which essentially means 35 basis point with a likely change of stance. But if you really ask me, I think, in my opinion, this would be too early for RBI to really box itself in by changing its stance. As some of my fellow panelists have also indicated, that there are still a lot of uncertainties around the path taken by the G7 central banks. So I think in that backdrop, it would make sense for RBI to keep its options open. So as of now, 35 basis point with no change in stance.
Okay, Abik, final thoughts, because we just have less than a few seconds to go before the governor speaks.
Well, let's just see. I mean, I think 35 is pretty much the consensus. I'm just worried that it could even be a 50, given some of the recent developments. Hopefully for the markets, at least, it is not desirable and it will not happen. But I think the challenges remain both on the external side as well as on domestic inflation. And we could see some moderation going forward. But how much of it is due to the base effect, and how much of it is sort of a genuine slowdown in pricing power of companies, of other entities, is really an open question, and we'll have to sort of wait and see how not only how the RBI
25-30 minutes. I propose to do it also in the same length of time today, and all the viewers, everyone have been very patient, so thank you for your patient hearing. And this is the statement for the monetary policy meeting we had, which concluded today morning. So let me now make the statement. As we come to the end of yet another turbulent year, the global economy is still marred by profound shocks and unprecedented uncertainty. Mixed signals are emanating from geopolitical situation and financial market volatility. In the beginning of this year, that is 2022, just as COVID pandemic was receding, the war in Ukraine overwhelmed the world in a black swan moment and fundamentally altered the global economic outlook. Surges in food and energy prices and shortages in key staples have severely affected the poorer sections across the world. Though international food, energy and other commodity prices have moderately in recent times, inflation remains high and broad-based, and this is something which we see world over. The IMF has projected that more than 1/3 of the global economy will contract this year or next year. While no country is spared the ill effects of such large shocks, emerging market economies, that is EMEs in particular, the ones dependent on food, energy and commodity imports, have been the worst affected. Looking beyond the pandemic and the war, fragmentation in finance and technology is also adding to the forces of deglobalization. Supply chains are being redrawn on considerations of geopolitical security, leading to what is now come to be known as reshoring and friendshoring. Food and energy security, together with climate change, have become the biggest challenges to the world. In this hostile international environment, the Indian economy remains resilient, drawing strength from its macroeconomic fundamentals. Our financial system remains robust and stable, and corporates are healthier than before the crisis. Bank credit is growing in double digits for 8 months now. India is widely seen as a bright spot in an otherwise gloomy world. Yet, our inflation remains elevated, as in most parts of the world. Global spillovers continue to impart volatility and uncertainty. Let me now focus on the deliberations and the decision of the Monetary Policy Committee meeting, and this is something which I think the key thing about which the market is eagerly awaiting. Now, the Monetary Policy Committee meeting met on 5th, 6th and 7th December. Based on an assessment of the macroeconomic situation and its outlook, the MPC decided by a majority of 5 members out of 6 to increase the policy repo rate by 35 basis points to 6.25% with immediate effect. Now, I think this is one occasion where the market expectations and the decisions of the Monetary Policy Committee are by and large aligned. And there are several interpretations whether when the market expectation and the monetary policy decisions are aligned, whether they are, they have to be taken as a perfect monetary policy or otherwise, but that debate can happen some other time. Now, consequent to this increase in the policy repo rate by 35 basis points, the standing deposit facility, that is the SDF rate, stands adjusted to 6%, and the marginal standing facility rate and the bank rate to 6.5%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Let me now elaborate on the MPC's rationale behind these decisions relating to the policy rate and the stance of the monetary policy. Growth prospects across the world are dampening. Financial markets remain nervous and are characterized by high volatility and price swings. For the Indian economy, the outlook is supported by good progress of rabi sowing, sustained urban demand, improving rural demand, a pickup in manufacturing, rebound in services, and robust credit expansion. Consumer price inflation moderated to 6.8% year-on-year in October as expected, but still it remains above the upper tolerance band of the target. Core inflation is exhibiting stickiness. While headline inflation may ease through the rest of the year and in first quarter of 2023-24, it is expected to rule above the target. The medium-term inflation outlook is exposed to heightened uncertainties from geopolitical tensions, financial market volatility, and the rising incidence of weather-related disruptions. On balance, the MPC was of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, break core inflation persistence, and contain second-round effects. I would read this sentence again. The MPC was of the view that further calibrated monetary policy is warranted to keep, number 1, inflation expectations anchored, number 2, break core inflation persistence, and number 3, contain second-round effects. These actions will strengthen the medium-term growth prospects of the Indian economy. Accordingly, the MPC decided to increase the policy repo rate, as I have said, by 35 basis points to 6.25% and to remain focused on withdrawal of accommodation while supporting growth. As regards the stance of the monetary policy, the MPC took a holistic view of the policy rate and the liquidity conditions relative to inflation. Adjusted for inflation, the policy rate still remains accommodative. Over the next 12 months, Inflation is expected to remain higher than 4% target. System liquidity remains in surplus with an average daily absorption under the liquidity adjustment facility, that is LAF, of 1.6 lakh crore in November this year. The overall monetary and liquidity conditions remain accommodative, and hence the MPC decided to remain focused on withdrawal of accommodation. I would now like to provide our assessment of growth and inflation. First, I will take up growth. According to the latest data released by the National Statistical Office, that is NSO, the real gross domestic product posted a growth of 6.3% year-on-year in the second quarter of this year, driven primarily by private consumption and investment. This also is in line with our expectations. Going into the third quarter of this year, economic activity continued to gain strength in the month of October. Urban consumption firmed up further, driven by sustained recovery in discretionary spending, especially on services such as travel, tourism, and hospitality. Passenger vehicle sales and domestic air passenger traffic posted robust year-on-year growth. Rural demand is recovering as reflected in the pace of tractor and retail two-wheeler sales, with rising farm activity. Investment activity is also gaining traction. Non-food bank credit, and this is something very important, non-food bank credit rose by rupees 10.6 lakh crore during April to November as compared with an increase of 1.9 lakh crore last year. The total flow of resources to the commercial sector, expanded by rupees 14.7 lakh crore during this year up to November, as compared with rupees 6.8 lakh crore in the same period last year. On the other hand, the drag from net external demand further accentuated in October as merchandise exports contracted by 12.1% year-on-year, after expanding during the previous 19 months. Merchandise exports expanded by 10% in October. On the supply side, the agricultural sector remains resilient. Rabi sowing got off to a strong start. The area sown so far is 6.8% higher than the normal sown area, and this is the position as on 2nd December this year. The manufacturing PMI rose from 55.3 in October to 55.7 in November. The PMI for the services sector also expanded from 55.1 in October to 56.4 in November. Incidentally, both manufacturing and services PMIs for India in November are among the highest in the world. Construction activity is picking up after the end of the southwest monsoon, as indicated by high growth of steel consumption in the month of October. Going ahead, investment activity will get support from government capex. A pickup in share of fixed assets in total assets of manufacturing companies was visible in the first half of this year. I have given the data in the footnote of my statement, and the statement, as you know, will be uploaded in our website immediately after my statement is over. You could have a look at the numbers. According to our surveys, consumer confidence has further improved. I go on. Manufacturing and infrastructure sector firms are optimistic about the business outlook. Services sector firms also expect activity to expand. In an interconnected world, we cannot remain entirely decoupled from the adverse spillovers from global slowdown and its negative impact on our net exports and overall economic activity. The biggest risks to the outlook continue to be the headwinds emanating from protracted geopolitical tensions, global slowdown, and tightening global financial conditions. Taking these factors into consideration, real GDP growth for the current year, that is 2022-23, is projected at 6.8%, with the Q3 at 4.4% and Q4 at 4.2%. The risks are evenly balanced. Real GDP growth is projected at 7.1% in the first quarter of next financial year, that is 23-24, and 5.9% in the second quarter of the next financial year. Now, let me highlight and stress that even after this, even after this marginal revision in our growth projection for 22-23, as you know, earlier we had projected 7%, now we are marginally moderating it to 6.8% for the current year. Now, even after this reduction or revision, even after this revision in our growth projection for 2022-23, that is the current year, India will still be among the fastest growing major economies in the world, and that is something which I think needs to be kept in mind. Let me now turn to inflation. The inflation trajectory has largely evolved in line with the outlook given by us in the month of June, that is in the June 2022 policy. Going forward, food inflation is likely to moderate with the usual winter softening and the likelihood of a bountiful Rabi harvest, but pressure points remain in the form of prices of cereals, milk and spices, in the prices of cereals, milk and spices in the near term. The main risk is that core inflation, that is CPI excluding food and fuel, remains sticky and elevated. Overall, CPI price momentum remains high. Risks from adverse weather events add uncertainty to the outlook. Global commodity prices, including crude oil, have undergone some downward correction. But uncertainty continues to surround the near-term outlook in view of the prolonging of geopolitical hostilities. The outlook for the US dollar and hence imported inflation also remains uncertain. Moreover, the resurgence in domestic services sector activity could also lead to price pressures, especially as firms pass on the input costs. Taking into account these factors and assuming an average crude oil price, that is Indian basket, of $100 per barrel, headline inflation is projected at 6.7% for the current year, with the third quarter at 6.6% and the fourth quarter at 5.9%. The risks are evenly balanced. CPI inflation for the first quarter of next financial year, that is 23-24, is projected at 5%, and the second quarter of next financial year at 5.4% on the assumption of a normal monsoon. Now, what do these growth and inflation scenarios convey? Let me summarize. GDP growth in India remains resilient and inflation is expected to moderate. But the battle against inflation is not over. Pressure points from high and sticky core inflation and exposure of food inflation to international factors and weather-related events do remain. While being watchful of the impact of our earlier monetary policy actions, we will keep Arjuna's eye on the evolving inflation dynamics and be ready to act as may be necessary. Our actions will be nimble and in the best interest of the economy. The aspect of growth will obviously be kept in mind. Now, over the last few days, and as usual at the time of every monetary policy, pre or post monetary policy discussion, there is a lot of discussion in the media, in the, among various informed circles, whether the RBI statement is hawkish or dovish or otherwise. Now, I leave it to you to interpret whether it is a hawkish statement or a dovish statement or, it is something else. But so far as we are concerned, I would like to state that the growth continues to maintain resilience. 6.8% in the current context, when the rest of the world there is acute slowdown of growth, 6.8% is a very strong growth impulse. That is something, the first point. Second thing is that the problem of inflation is not over, so therefore the battle against inflation has to continue, and we are in a state of, we will monitor all the incoming data, we will also continuously assess the future outlook, and we stand ready to act as may be necessary from time to time. The focus on inflation control continues, and there will be no let-up in our efforts to bring down inflation to more manageable levels, and as we have said, first to below 6%, that is within the target range, and then move closer towards 4% target. So this is in the para 15 of my statement. Those of you who are interested could again refer to para 15 of my statement, which I think really summarizes all that we have been trying to say in this monetary policy statement. I would now like to move to the liquidity and financial market conditions. Overall system liquidity remains in surplus. During October-November, the average total absorption under the liquidity adjustment facility was 1.4 lakh crore, down from the average of rupees 2.2 lakh crore during August-September. In the period ahead, liquidity conditions are likely to improve due to several factors, which would include moderation in currency in circulation in the post-festival period, pickup in government expenditure in the last few months of the financial year, and higher forex inflation due to the return of portfolio investors. Tax outflows and currency demand do produce transient episodes of tight liquidity, but a holistic view needs to be taken. I reiterate that the Reserve Bank remains nimble and flexible in its liquidity management operations to meet the requirements of the productive sectors of the economy. Therefore, although the Reserve Bank remains in absorption mode, we are ready to conduct LAF operations that inject liquidity as may be needed through our main operations. In doing so, however, we will look for a durable sign of a turn in the liquidity cycle when banks draw down large part of their standing deposit facility and variable rate reverse repo, that is VRRR balances. The Reserve Bank remains committed to flexibility and two-sidedness in liquidity operations. But market participants must win themselves away from overhang of liquidity surpluses. As part of our gradual move towards normal liquidity operations, we have decided to restore market hours, that is 9 a.m. to 5 p.m. in respect of call, notice, term money, commercial paper, certificates of deposit, and repo in corporate bond segments of the economy, as well as for the rupee interest rate derivatives. The pace of transmission of monetary policy actions to lending and deposit rates has quickened in the current tightening phase. Beginning May 2022, the weighted average lending rate, that is the WLR, on fresh and outstanding rupee loans, have increased by 117 and 63 basis points respectively during the period May to October. On the deposit side, the weighted average domestic term deposit rate on fresh and outstanding deposits have increased by 150 basis points and 46 basis points respectively during the same period, that is from May to October. We are keeping a close watch on this process of transmission. The appreciation of the US dollar this year, which precipitated large-scale depreciation of all major currencies, including the Indian rupee, has drawn wide attention. It is important to make an objective assessment of the movement of the Indian rupee in the context of global and domestic macroeconomic developments and financial market conditions. Through this episode of the US dollar appreciation, the Indian rupee's movements have been the least disruptive relative to the peers. In fact, the Indian rupee has appreciated against all other major currencies except a few. Cross-country comparisons of exchange rate movements are often made on inflation-adjusted basis, or what is called in real effective terms. On a financial year basis, that is from April this year to October, the Indian rupee has appreciated by 3.2% in real terms, even as several major currencies have depreciated. The story of Indian rupee has been one of India's resilience and stability. As stated by me in a recent speech, the terminal rate for the US Fed is anybody's guess. But it cannot be a case that their monetary policy will be tightened endlessly. When the tightening is over, the tide will surely turn. Capital flows to India will improve and external financing conditions will ease. In this complex world with both push and pull factors at play, the Indian rupee, which is market determined, should be allowed to find its level, and that is precisely what we have been trying to achieve. We must deal with the current global hurricane with confidence and endurance. I would now like to focus on the external sector. The external sector has been affected by strong global headwinds. Slowing global demand is weighing on our merchandise exports. The growth of merchandise imports is also decelerating. At the same time, the impact of the terms of trade shock due to the war in Ukraine is getting gradually normalized. It is also important to take cognizance of India's innate buffers. The growth of services exports, mainly contributed by software, business and travel services, remained robust at 29.1% in April to October this year. Remittances are scaling new heights and the outlook is optimistic with pickup in activity in the Middle East. According to the latest update of the World Bank, India's remittances are estimated to grow by around 12% to $100 billion in 2022, and this is against $89.4 billion in the last calendar year 2021. In the first quarter of this year, and very importantly, in the first quarter of this year, remittances to India rose by 22.6% year on year. The net balances under services and remittances remains in large surplus, partly offsetting the trade deficit. And this gives us a lot of comfort about the size of our current account deficit. Consequently, even if the current account deficit is higher than what it was in 2021-22, it is eminently manageable and within the parameters of viability. On the financing side, net foreign direct investment, that is FDI flows, have remained robust and have risen to $22.7 billion during April to October from $21.3 billion in the corresponding period of last year. Foreign portfolio flows have resumed in recent months and were positive at $11.8 billion during July to 5th December, led by equity flows. As a result of the measures announced by the Reserve Bank on 6th July, you will recall on 6th July, we had announced a series of measures, and that was the time when I think the dollar appreciation had started. So we had announced a series of measures to attract more and facilitate more currency inflows, more forex inflows into India. Now, as a result of these measures announced by us on July 6th, to enhance forex inflows, new external commercial borrowings, that is ECB agreements, have been concluded for $8.6 billion. This includes $5.1 billion, which exceed the earlier threshold of $750 million under the automatic route. As you know, we enhanced, earlier in the automatic route, the limit was $750 million. We enhanced it to $1.5 billion. The size of forex reserves is comfortable and has also increased. It has gone up from $524.5 billion on 21st October to 561.2 billion as on 2nd December. And that is a substantial increase of nearly about, let's say about $36.7 billion. If the arithmetic you may please check. Now this covers around 9 months of projected imports of 22-23. Further, India's external debt ratios are low by international standards. I have given how it is low by international standards in the footnote of my statement. Those of you who are interested may like to have a look at it. I would now like to announce certain additional measures. The first one relates to, and there are 4 of them. The first one relates to SLR holdings in held to maturity, that is HTM category. To provide further flexibility to banks in managing their investment portfolios, it has been decided to extend the dispensation of enhanced HTM limit of 23% up to March 31st, 2024. Banks will now be allowed to include securities acquired between 1st September 2020 and March 31st, 2024 in the enhanced HTM limit. The HTM limits would be restored from 23% to 19.5% in a phased manner starting from the quarter ending 30th June 2024. The second measure relates to enhancing the mandates of UPI, that is Unified Payments Interface. You would have seen that almost in every policy statement we are announcing several measures relating to our payment systems and with particular focus on the UPI. And UPI, as you know, has emerged, is now globally accepted as one of the best payment systems anywhere in the world, and it has been our constant endeavor to try and improve or try and deepen and improve the reach of UPI in India. Now, this announcement relates to enhancing the mandate of UPI payment, that is UPI. The UPI has emerged as the most popular retail payment system in India. It currently includes functionality to process payment mandates for recurring as well as single block and single debit transactions. The capabilities in UPI will be further enhanced by introducing single block and multiple debits functionality. This facility will enable a customer to block funds in his or her account for specific purposes which can be debited as needed. This will significantly enhance the ease of making payments for investments in securities through the retail direct platform as well as e-commerce transactions. The third announcement relates to expanding the scope of the Bharat Bill Payment System, or what we call the BBPS. The BBPS has been steadily expanding since its launch in 2017. At present, it handles recurring bill payments for merchants and utilities and does not cater to non-recurring bills. It also does not cater to bill payments or collections such as payments of fees for professional services, education fees, tax payments, rent collections, etc. for individuals, even if those are of recurring nature. Therefore, the scope of BBPS is being enhanced to include all categories of payments and collections. It includes now both payments as well as collections, both recurring and non-recurring, and for all category of billers, that is both businesses and individuals. This will make the BBPS platform accessible to a wider set of individuals and businesses who can benefit from the transparent payments experience, faster access to funds, and improved efficiency. The fourth and the final announcement is very important. Hedging of gold, that relates to hedging of gold in the International Financial Services Center, IFSC. Resident entities in India are currently not permitted to hedge their exposure to gold price risk in overseas markets. With a view to providing greater flexibility to these entities to hedge the price risk of their gold exposures, resident entities will now be permitted to hedge their gold price risk on recognized exchanges in the IFSC. This measure will benefit importers and exporters of gold such as jewelers and industries which use gold as an intermediate or raw material. Let me now try and conclude. The last 3 years have been unusually challenging as we have encountered multiple shocks. The buffers we built in the years leading to COVID-19 in terms of accumulating reserves and inflation averaging close to the target came good to deal with these repeated shocks. In this arduous period, our constant endeavor has been to take timely and effective measures. It is gratifying to see that our policies have yielded positive results. And just at the cost of repetition, let me say that the growth in India remains resilient in such a hostile environment, international environment. A 6.8% growth definitely is robust. Inflation compared to other countries is lower, but so far as India is concerned, we have to focus on our inflation, and we are extremely watchful of the evolving inflation dynamics. We constantly in the Reserve Bank, we keep on assessing various incoming data almost on a day-to-day basis, and as I have said, we are committed to bring it down in the, as I have mentioned, first to below 6% and then take it closer to 4%. We are what we have called, what I have described, we will keep an Arjuna's eye on inflation, and this is something which I had explained in one of my earlier speeches, and we will be ready to act. Our actions will be nimble. The course of our future policy will duly consider new data releases and the evolving outlook of the economy, as well as the effect of our past actions. In meeting the challenges thrust upon us by a hostile global environment, we should not lose sight of the task of improving the long-term potential of our country. Green transition, reconfiguration of supply chains and logistics, production-linked incentive schemes, digital banking and financial services, and innovative technologies offer immense opportunities for the Indian economy. As we enter 2023, India's G20 presidency provides us a historic opportunity to play a bigger role in the international arena. The theme of our presidency, Vasudhaiva Kutumbakam, that is, the world is one family, reflects our vision of global cooperation for universal welfare. We must remain optimistic and derive inspiration from the words of Gandhiji. I quote, "Let no one think that it is impossible because it is difficult. It is the highest goal, and it is no wonder that the highest effort should be necessary to attain it," unquote. As the current year ends and a new one awaits, I wish you all a happy new year in advance. Thank you. Namaskar.
All right, so let me quickly summarize what the RBI governor has just announced. The rate hike of 35 basis points is exactly as the market had penciled in. But I think the bigger disappointment will come on the stance. Many were expecting that there would at least be a tweak in the wording of the stance to indicate future action, but that has not been done. But there are some important comments to indicate perhaps that. Let me start with the 35 basis point rate hike. It was not a unanimous decision. Again, 5:1 voted in favor, and the stance has been retained with a 4:2 majority. Let me quickly toss it to Lata as well, who is joining us from the RBI headquarters. Lata, quickly your takeaways.
Well, I think the important point is that the stance has not changed but tweaked very slightly. 35 basis, of course, was a given. The former statement was the MPCs of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, restrain the broadening of price pressures and preempt second round effects. Now, restrain the broadening of price pressures has been replaced by breaking the core inflation persistence, which means it's almost the same. If anything, I would say that they have been a little more harsh or demanding that they should bring down inflation. My sense is that stance is by no means softened, which explains why there were only 4 people supporting it. My sense is that Dr. Verma and Dr. Goyal would have wanted a softening going by their minutes. So it's as expected, 35 basis, and the stance retained except for this one phrase, adding, breaking the persistence of core inflation. My sense is it is as hawkish or as it was in the September 30 policy. In terms of forecasts, they have brought down the growth forecast from 7% to 6.8 for this year, and that has been taken off largely from third and fourth quarter. Third quarter was 4.6, it's come down to 4.4, and fourth quarter was also 4.6, it's been brought down to 4.2. There is also an additional growth forecast for next year. Next year, Q1 was originally 7.2, it's brought down to 7.1. We have a new forecast for the second quarter, which is 5.9. On inflation, there is not much of a change. Current year inflation remains at 6.7, but fourth quarter, remember, they expected it to come to 5.8. Now it is 5.9, which means we will just about come below the policy target mandated rate of 6%. It looks a bit dibbly-dobbly. The Reserve Bank is genuinely worried that they may not get to 5.9, it may be 6, in which case it would be 15 months of not achieving the target. That explains the persistence of the stance as it was in the September 30 policy. My sense is it's certainly a little more hawkish than what the market was expecting. There was an expectation of a slight dilution of stance. There is no dilution of the stance as I see it. But let me leave it to the experts now. First up, Kaushik, you were with us, so tell us, any change in the stance?
No, so Lata, we were expecting the stance to be tweaked a bit more, so they haven't done it. And I think what RBI has done is kept the optionality with them, because a lot of data points are still supposed to come from the Fed, the inflation data in December, the Fed hike and the terminal Fed funds rate. So I think they don't want to box themselves up in discussing that this is the last rate hike. But by the time you come to February, my guess is inflation will start moderating. Already I'm looking at inflation in November being around 6.4, 6.5. So, the story between now and February can change quite significantly. And my guess is RBI having done 35 basis points, having downgraded growth by 20 basis points, which means that FY24 growth forecast would be further under downside risk. And if you can see inflation in the 5% handle in April to September, the average is coming to 5.2. So 5% for April, June, and 5.4 for July, September. So the average is 5.2. Your policy rate is at 625, which is 100 basis points higher in positive real rates from a forward-looking basis. I think by the time you come to February, RBI probably will not do any more rate hikes, and 625 would be the terminal repo rate. But they have kept the option in case they need to do, they might hike by another 25 basis points.
Okay. Well, Upasna, very quickly, are you expecting another rate hike?
Lata, I think it's a fine call, but nonetheless, I do see a reasonable probability of the last 25 basis of a rate hike. Just to point out, in February, they will have two more readings, which will definitely be anchoring around 6.3 to 6.5%, which still itself will be quite discomforting for them. It's only in the April policy when they probably will be comforted by at least one reading, which will be just about touching 6% or maybe a tad below 6%. And that's when they could think of a pause. Talking about real policy rates, I think, in the past, they have mentioned that at least...
Upasna, I'll come to you in a minute. Let me get the banker in because we want to know how things will pan out on credit growth. Mr. C.S. Setty is with us. Mr. Setty, what's your sense? Will both deposit and lending rates go up now?
Thank you, Lata. I think, first of all, I definitely share the optimism with which Governor has concluded his speech. A few things what we noticed in his speech, of course, is the continued support in liquidity. That is a very good statement to hear. So having said that, the credit growth, of course, has been phenomenal in the Q2. And as we stated earlier, from SBI side, I think it will be a double-digit credit growth in the range of 15 to 16%. I think that is likely to continue. The deposit rates, of course, will have to be readjusted based on the liquidity conditions. I am sure that, as again often repeated, for us, deposit is a franchise. we may not really be looking at competing with other banks just to garner. We have a very significant market share, which we'll definitely like to maintain. But I think there is the interest rate movement on deposits may not be secular, in the sense that there are banks like us who have sufficient liquidity. We can raise this. Obviously, both on the loans. One important thing which we must remember is that most of the loans are moved to floating rate. As we speak, in SBI alone, around 75% of the loans are either MCLR linked or external benchmark linked. So there will be transmission of interest rate as we increase the deposit rate. This is my the take, and the repo linked rate, of course, will automatically move.
Okay, fair enough. Lending rates will move. Deposit rates, we will have to get the word from the bankers. I wasn't expecting what your bank will do. Of course, you'll wait for your ALCO. But we would like to know whether deposit rates will rise in the system. I just want to apprise that the indexes are absolutely flat at this point in time. There is hardly any reaction on the stock markets. Bond yields went up bang when the governor read out the stance, and there was no sign of any change or tweak to dovishness. So we saw it go all the way to 7.29. The 10-year yesterday was at 7.23. They shot up at the time, and I think they are more or less there. The rupee again is almost flat. It did go to 82.5 plus, now at 82.48, but more or less on the same lines. Let me get Amandeep Chopra in. Amandeep, any key takeaways from what the governor said?
Yeah, Lata, I think clearly this policy was a lot more hawkish than what the markets were penciling in. So I think you've obviously seen the markets react accordingly. But, I think at the current juncture, I also feel it was quite appropriate. Like I mentioned, the RBI wanted to keep its options open. So there are three key takeaways from my perspective. One is clearly in terms of, the dissent. So it's quite likely that, as we saw in the previous policy minutes, some of the members may still feel that we need to see the transmission of the earlier rate hikes, and they would want to wait and watch. But given the inflation trajectory as outlined so far, I guess it may not be appropriate, for RBI to sort of, be in a wait and watch mode. So I guess they need to sort of react to the forecast that they've made. The second, I think, is clearly in terms of stance. I think you were right in pointing out that there is a material change in bringing in core inflation as part of their, stance. Because if you look at it, while headline inflation will decline and the trajectory has been more or less tweaked slightly, but if you really need to anchor household inflationary expectations, core inflation, which is still being forecast to be at around 6% over the next, 12 months, is a material driver of, household inflationary expectations. So I guess from that perspective, it would be relevant to, now maybe start focusing on that. And that's something new, which, RBI has never really talked about earlier as part of their monetary policy stance. The third, I think, is also, if you, read through the speech, there was a lot of emphasis around growth. In fact, in spite of tweaking the growth trajectory by 20 basis points for the current year, I think, and highlighting some risks in the coming, financial year as well, you would have noticed that, the governor did spend a lot of time trying to justify that even with this sort of a growth trajectory, we still would be growing at a fairly robust clip versus, the rest of the world. And at the same time, not diluting the inflation focus. So, all along, I think you did mention the urgent's eye on inflation, which I think is an important, takeaway here as well. And finally, I think on the rupee, a lot of emphasis on the way, a lot of references to rupee's natural level and how it's sort of reacted to the recent developments, both against dollar and so on. I think these are important, messages for the markets to pencil in. And finally, I must also mention from the market's perspective, while it's a hawkish policy, the extension of HTM was at the margin a positive, and you did see the markets sort of bounce back slightly, when that was announced.
Well, Mr. Rajiv, Anand, let me bring you in on that, on your key takeaways. That HTM limit that Amandeep mentioned now enhanced the limit up to 23% for up to a period of March 31st, 2024. Your key takeaways, we have Mr. Setty from SBI telling us, of course, repo-linked rates will immediately go up, but deposits will go up with a lag. What is your sense there?
So, Ritu, I think what we are seeing is that non-retail deposit rates have already gone up and gone up quite sharply. On the retail side, like banks like us, continue to get reasonable flows. But I think it's inevitable that deposit rates will go up. We are also competing with other products, including large flows into equity markets, into small savings, and so on and so forth. So I think to that extent, deposit rates will need to go up to some degree. On the other side, I do believe that most of the rates have adjusted to pre-pandemic levels, but I think the one space that has not yet adjusted to pre-pandemic levels is corporate rates. And if you see spreads for corporate bonds, for example, over G-Secs, they still continue to be very, very tight. And in an environment where we are seeing more demand from working capital, from term loans, and even refinancing some of the external borrowings, we do believe that that demand from the corporate side is going to be quite strong. And I think it is inevitable that corporate spreads will go up fairly meaningfully from here as we go forward.
Okay. Thanks for that, Rajiv. You expect deposit rates to go up meaningfully very quickly, Rajiv?
I think deposit rates will have to go up, Lata. I think if you look at pre-pandemic levels, a 1-year FD used to be in the vicinity of about 7%. We are still, in most cases, we are between 6 and 6.5%. So I think, yes, deposit rates will need to go up. Whether they will go up quickly or not, I think is moot. But ultimately, please remember that as retail deposits rates to go up, it is inevitable that with a small lag, MCLR and pricing on the asset side will go up as well. So I think both will happen.
Yeah, take your point. Yeah, Rajiv, the point is that if bank deposit rates and savings rates start going up, then there could be some impact on the flows into equity markets as well, or into other capital markets as well. But more on that later. I do want to get back to Mr. Setty on this, higher price that corporates will have to pay to borrow from the market as well. But before I come to you, Mr. Setty, just a word on the bond and the rupee market from Ashhish Vaidya. Ashhish, do you think the rupee was one big reason why the RBI chose to be as specific about or as hawkish as they did sound? Your takeaways for the rupee and the bond market?
So, Lata, first of all, good morning. And I think, yes, rupee was a concern to my mind with the RBI. I'll not say it was a major concern, but like Governor has already mentioned, I think we have really done well vis-a-vis the crosses, etc. And really, we were a function of what really happened via the dollar strength. But having said that, obviously, the headline obviously makes a difference. So I think, yes, at the back of the mind, this is one of the clear reasons. And I think important takeaways from the policy is clearly the government has mentioned that we are not alone, right? Because we are a global economy. We are part of the global economy. So what's happening elsewhere in the world is going to impact us. And we are on course to become a 5 trillion. We are going to be a major economy in the world. So obviously, we'll be a function of that. For me, a couple of other important things. I think the governor, to my mind, has hinted also the fact that don't take liquidity overhang for granted. I think that's a very important statement, because I think that really shows that we are going to be towards either squarish liquidity or a little bit positive or negative liquidity. So, that actually brings in the point which Rajiv was making, which is basically the corporate spreads actually sort of need to move up. I think that's a real possibility. And yes, so basically what I'm trying to say is that the liquidity part of the interest rate was not getting priced in so much because of the liquidity overhang. So the liquidity risk will start getting priced in the market, both in the form of deposits as well as in the form of lending rate by the banks. So I think that's going to be critical. But overall, I think everything was around the expectation of the markets, but slightly on the hawkish side on the liquidity, I would think. And I think he's kept his doors open because
Ashhish,
if the US, if the US rate, I just want to complete one point. If the US rate actually heads towards 490 to 5, I think then we need to look at the differences. And then the terminal rate is not just about India. I think we have to look at it globally, and we may then pivot towards 6.5 or maybe 675. It all depends on how things pan out. And we are in a fairly dynamic situation.
Okay, I was interrupting you only because I want to request you and Amandeep to look at your screens if you are sitting near your screen, or get from your dealers. What is the market now penciling in from the OIS rates in terms of a February hike? Kaushik here tells me he's not changing his mind, and Upasna was a little unsure. But my sense is the OIS markets may be penciling in a slightly higher bet on rate hike. I'll come to you and Amandeep on that in just a minute. Mr. Setty, the important point Rajiv is also making, that loans will get more expensive for corporates. So, two questions to you. Do you think that will have any impact on the pace of growth? Credit growth has been fantastic, 17% for the industry itself. So, do you expect that to get impacted as corporate spreads increase over G6?
So it all depends on where the credit growth is coming from. I think Rajiv has also mentioned that it is mainly coming from your working capital drawals, right? I think if as long as the credit growth is coming because the capacity utilizations have gone up and the working capital utilizations have gone up, there will not be much movement in the rates because these are all predetermined rates, right? Except the MCLR hikes which happen, which are passed on to the corporates. But when it comes to the term loan pricing and bond markets, I believe because only the best rated corporates are accessing either the markets or the loan markets, the pricing increase what we expected because of the overall liquidity overhang being removed from the system is not witnessed. But as the demand grows up, and also the demand comes from the lower category of corporates, lower rated corporates, obviously the pricing adjustment will be done. But I don't think the growth will definitely immediately impacted. As we said, it is more in terms of what investments, the private investments cycle will kick in. It is still a little away. While we see that good amount of growth in infra space is there, particularly in the renewables and road sector. But if it is expansion is taken up in the core sector, and term loans and market instruments are raised by corporates in a big way, we may witness the rates going up and also without impacting the growth. This is my view. I think even the governor has mentioned that the growth trajectory seems to be still positive here when compared to others. There could be some impact on the export-dependent corporates. The global scenario is changing. Is not really optimistic. Where the corporates dependent on the exports may likely to face headwinds, where their growth may be impacted. But I don't think the interest-related growth impact may not be significant.
Okay. All right. Mr. Setty and Rajiv, I'll let you all go on that note. If the RBI does not see a fall in growth, it will probably have to hike more, because they do want to slow down the pace of core inflation, and that will mean they have to bring down aggregate demand to some extent at least. A very quick rapid fire for all of you on whether you all see another hike. Kaushik.
We don't expect a rate hike in the next policy because
another hike. No, monosyllabic. No, Kaushik, monosyllabic, because we have to take a break. Upasna, one more hike?
Yes.
You expect, possibility. Amandeep?
Definitely.
Okay. Ashhish?
One more hike, but with a gap in a policy.
Okay, fair enough. Not in February, but later. Amandeep, could you check from OIS? Is the market also penciling in a little more chance of a hike?
Yes, Lata, it has. Actually, if you look at the swap curve, it's broadly moved up by about 6 odd basis points. So pre-policy, I think the peak rate expectations were about 6.6, and 1 year forward outlook was about 6.38. It's moved up by 10, 12 odd basis points. So 1 year outlook for repo rate is about 6.5, and the peak rate has actually moved to 6.75.
Got it. There you are. I mean, it's clearly a status quo in terms of stance, which will be read as a hawkish statement, because there was an expectation that something looser, slight bit of dovishness will come in the stance. It's not come, and we are seeing the Sensex, the Nifty and the Bank Nifty give up some of their gains, about 0.25% lower. We take a break and we're going to come back with more analysis and more big guests to celebrate our birthday.